Gold just suffered its worst single week in 43 years. Silver has literally been cut in half. If you're only looking at standard retail price charts, you are staring at a slaughter. You're watching retail investors panic sell their physical stacks at rock-bottom premiums. But if you look at the underlying institutional data, the derivatives market, and the shadow inventory at the exchanges, you will see the exact opposite. You are looking at the greatest calculated wealth transfer of this decade. Welcome back to Faultline Finance Channel. Today, we are not just looking at the surface of this precious metals carnage. We are going deep into the institutional plumbing. We are going to track the whale wallets, decode the margin calls that forced this flush, and look at the geopolitical powder kegs driving the hidden economy. The mainstream media is telling you the commodity supercycle is dead. But the data I am about to show you proves that institutions are crashing paper markets specifically to vacuum up physical assets on the cheap. Stick with me until the very end, because the last 5 minutes of this video will completely rewrite how you view the next 12 months. Let us get into the exact mechanics of how a 43-year record crash was manufactured. Billions of dollars are shifting hands, while retail traders are blinded by red candles on their screens. When fiat currencies fail mathematically, big banks do not send a press release. They orchestrate a panic. They deliberately trigger stop losses and force weak hands into total capitulation. Over the past 72 hours, the volume of short selling in the silver futures market has reached unprecedented levels. This is not organic selling pressure. This is a weaponized algorithm designed to break your resolve. By the time we finish breaking down these specific charts, you will understand exactly why the whales are salivating over these prices. You will see the exact entry points the smart money is targeting. Do not let the illusion of paper derivatives steal your actual wealth. Let us pull the first chart. To understand why silver dropped by 50%, you have to understand the difference between a fundamental crash and a liquidity event. What we just witnessed was not a rejection of gold and silver as sound money. It was a massive, systemic margin call. When major hedge funds and institutional players get overleveraged in equities, and those markets suddenly reverse, the brokers demand collateral immediately. They demand cash. And when institutions need billions of dollars in exactly 0.5 seconds, they sell what they can sell. Gold and silver are highly liquid. They act as the ultimate cash register in a crisis. This happened in 2008 and 2020. The paper contracts for precious metals are dumped onto the open market. This creates an avalanche of supply, driving the spot price down. But here is the critical data point that Faultline Finance has uncovered. While the paper price was bleeding out, physical vault inventories were draining. Institutional whales stepped in at the exact bottom. They used the panic to cover shorts and initiate massive long positions in physical bullion. The ratio of paper claims to every 1 ounce of registered physical silver sitting in the vaults spiked to absolutely historic levels. Imagine 100 people holding a ticket for the same single ounce of silver. That is the leverage we are talking about. When the price drops, it's because paper players were forced to liquidate trades. Think of it like a house fire. You do not sell your gold because it is worthless. You sell it because you need to pay the firefighters to save your mansion. But who is on the other side? It is the big banks and the central banks of the East, taking physical metal from the desperate. This is the definition of a wealth transfer. We are seeing a total decoupling between the spot price and the actual cost of metal. While the screen says silver is down 50%, the premiums at the local coin shops and bullion dealers are skyrocketing. This is a classic supply mismatch. The paper market is broken, and the whales are buying the fear, buying the panic. Every time we have seen a liquidity-driven flush of this magnitude, it has been followed by a violent move to the upside. In 2020, gold hit a bottom and raced to new highs within months. We are currently at that exact same inflection point. The tourists have been kicked out. Only the diamond hands and the institutional giants remain. This is where the math gets interesting. If only 1% of capital and failing fiat moved into silver now, there would not be enough silver on the planet. We are looking at a mathematical bottleneck. The exit door is tiny, and the crowd is about to start running for it. Next, we will look at the geopolitical triggers about to turn this liquidity squeeze into a full-blown supply shock. You cannot analyze this precious metals crash in a vacuum. You have to look at the global geopolitical chessboard. With escalating tensions involving Iran and the broader Middle East, the risk of supply chain disruptions for critical metals is at a multi-decade high. Yet, the price of gold plummeted. This divergence between geopolitical risk and spot price is the ultimate tell. It tells us the market is entirely dislocated from reality. At the same time, we have the Federal Reserve playing a dangerous game of chicken. The debt servicing costs on the national deficit are spiraling out of control, costing trillions of dollars every single year. The whales know that the current monetary policy is mathematically unsustainable. They know that fiat currency debasement is the only way out. So what do you do if you are a central bank or a Tier 1 financial institution? You engineer a final flush, you clear out the weak hands and the retail speculators who bought in on leverage. You buy back the physical assets at a massive discount before the inevitable pivot to monetary easing begins. The data shows clear accumulation patterns across the major commodity exchanges. They are buying the blood in the streets. We must also look at the massive shift in global trade. For 40 years, the world operated under a dollar-centric system. That system is cracking. We are seeing the rise of the BRICS nations, who are aggressively hoarding gold at levels not seen since the 70s. While the Western retail investor is selling their silver coins to pay for rising grocery bills, central banks are adding hundreds of tons. This is the shadow economy in action. It is a slow-motion bank run on the dollar, masked by the trading algorithms of Wall Street. On Faultline Finance, we track the flows, not just the headlines. When you see a drop in gold, ask who has the most to gain. By smashing the paper price, the powers that be create an illusion of stability. They make the dollar look like the only safe haven. But the physical reality is that there is a massive shortage of actual deliverable bullion. The exchanges simply do not have the bars. The geopolitical trigger for the next leg up will likely be a currency reset or a sudden escalation in the energy markets. If oil goes to $150 a barrel, gold and silver will not stay at these suppressed levels for more than a heartbeat. The energy cost to mine silver is rising every day. We are approaching a point where the production cost is higher than the spot price. Since 2020, nearly 40% of all dollars in existence were printed out of thin air. You cannot expect prices to stay down. It is like trying to hold a beach ball underwater. The deeper you push it, the more violently it will eventually pop back to the surface. We are currently in the eye of the storm. The smart money quietly builds their massive positions while they tell you gold is dead. The physical market is screaming that there is a shortage, while the paper market is screaming that there is a surplus. This is the ultimate paradox. At Faultline Finance, we choose to believe the physical reality. We choose to follow the metal, not the digital digits on a screen. The wealth transfer is happening right now, in real time. Are you going to be a victim of the squeeze or position yourself with the whales? This brings us to the final piece of the puzzle, the data that changes everything. If you have stayed with me this far on Faultline Finance channel, you are about to see the true motive behind this 43-year record crash. Over the past 72 hours, specifically looking at the most recent commitment of traders report and the commercial swap dealer positioning, the smart money has quietly flipped from net short to overwhelmingly net long. This is the exact same signature pattern we saw in 2008 and 2020, right before the massive bull runs that minted millionaires. The carnage you are seeing on your screen is the final brutal shakeout. The whales have successfully trapped the late retail shorters. They have absorbed every ounce of panic selling from the weak hands. For the next 48 hours, expect volatility to remain extreme as the remaining leverage is hunted down and liquidated. But make no mistake, the foundation for the next structural leg up in the commodity supercycle has just been violently poured in concrete. If you understand the difference between paper derivatives and physical reality, this crash is not a tragedy. It is an incredibly rare generational opportunity. As of today, gold is trading near $4,099 after a 31% correction from its January peak. Silver has taken a thumping 50% hit, dropping from $121 to just $60.96. While the headline says crash, the institutional desks at JP Morgan and Goldman Sachs are raising their year-end targets. They are targeting over $6,000 for gold and $80 for silver by the end of the year. They are telling the public one thing, while their internal models suggest a massive supply-demand imbalance is coming this summer. The world is facing a fifth consecutive year of silver supply deficits. Industrial demand for solar energy and electronics is projected to consume nearly 30% of all silver production this year alone. When you add the return of institutional investment demand, the math simply does not work at $60. Institutions are positioning for a reality where inflation roars back, and the purchasing power of fiat currencies continues its slow crawl towards zero. They are watching the Federal Reserve struggle to maintain independence amidst unprecedented political pressure and criminal investigations. They are watching the dollar index lose its grip as a global safe haven. You have to decide if you're going to let the engineered paper price scare you out of real tangible assets, or if you're going to follow the trail of the smart money. The physical vault drain at the COMEX is not a theory. It is a documented fact. Registered silver stocks are hovering near 10,000 tons, a level that historically signals a major price floor. When the inventory hits the bottom, the price has nowhere to go but up. We are at the end of the debt supercycle, and precious metals are the only assets that carry no counterparty risk. Thank you for watching Faultline Finance channel. We don't just follow the price, we follow the truth. If this deep dive helped you see through the fog of the mainstream media, then hit that like button right now. Subscribe to the channel so you never miss a critical update when the markets turn.